Thank you. Thanks for that introduction, Ali. So welcome to this session on the FSB Task Force on Climate-Related Financial Disclosures. What a long word. I'm going to talk about it just as the FSB Task Force. Well, we've got a fantastic panel with us today with different perspectives, financial analysts, stock exchange, and investor perspective too. So to introduce to you three of the task force members that are with us here today at the panel. Mark Lewis over this side, who is at Barclays, and Yo Lian Sem, Special Advisor to Singapore Stock Exchange, and also Martin Shanker, who you'll know, PRI Chair. Also at the conference with us today, we do have two other task force members, which has been fantastic, David Blood and also Mike Wilkins from Standard & Poor's. I'm also delighted to introduce to you our other panelists, Helen Wildsmith, who is Stewardship Director at investment firm CCLA and Strategic Advisor to the Carbon Disclosure Project, and has also led the Aiming for A coalition, if I may say that. And also Anthony Hobley, who's Carbon Tracker Initiative's CEO. So the task force is very much meant to be an industry-driven approach to improving company disclosures on climate-related risks and opportunities. So I wanted to start by asking you, the audience, as the global investment industry, to get a few questions, to get a sense of where you are. So we just wanted to run some poll questions. If you've got the conference app on your phone or on your iPad, if you go into the agenda section for this session and just see the polls bar, and you'll see there's 3 questions up there. We're doing a bit of an experiment, so I hope this poll works. If not, we're going to go back to a manual method of show of hands. So the first question I want you to think about, and just answer yes or no to, is, does your firm consider climate risk and opportunities at the board and senior management level? Yes or no? Okay, is it working? Does it give you the facility to do yes or no? It just give it. We'll begin in 6 hours. That's not so helpful. I think we'll be asleep then. Okay. I will be. I'll be on a plane. Okay, we're going to revert to, we'll revert to just doing manual in that case. So in that case, if I can just ask for a show of hands for yes. So if your firm does consider climate risk and opportunities at the board and senior management level, can you please put your hand up? All right, very healthy show of hands. Good, I'm pleased to hear it. Okay, I'm going to go on to the next question, which is, does your firm formally integrate climate risk into its risk management efforts? If your answer is yes, put your hand up. All right, about more than half the room. That's pretty healthy. Good, I'm glad to hear that. Now the trickier one. Is your firm planning to conduct a 2-degree climate-related scenario analysis? And if your answer is yes, please put your hand up. Okay. All right, much smaller proportion. Okay, very good. Well, that's given us a snapshot of where you, the industry, are. So I think what we can see from that is that there's some way to go in terms of investors having the tools to actually do the risk analysis. So I'm going to turn over now to Mark, who is going to very kindly, on behalf of the task force, just give us a bit of an introduction and overview for everyone here on what the task force's objectives are and a little bit on the implications for you as the global investment industry. Thank you, Mark.
Thank you, Sagarika. Good morning, everybody. So I'll just, I have a few slides, but I'll also make a few comments. And I think the most important thing to understand about the task force is really what the genesis is. And Mark Carney, the Governor of the Bank of England, but Chairman of the Financial Stability Board, so with his chairman hat on with the global remit, last year gave a very, very interesting speech called The Tragedy of the Horizon. And the essential thesis of that speech was that there is a big disconnect between the impact that climate change will have on future generations, on the one hand, and the lack of incentive today for business leaders and financial leaders to take action. And he summed this up by saying the tragedy of the horizon is that when financial stability is put at risk by climate change, if we don't take action today, it will be too late to act. And so, although we today may not face the worst consequences of the physical impacts of climate change, which will obviously fall and become worse over time on future generations, we run the risk of being the victim indirectly of climate change via financial instability. And therefore, he said, what we need is to create a market in a 2-degree world and in a transition to a 2-degree world. And to do that, we need better financial disclosure from companies and from financial services companies around this topic. So I think that is something we come back to continually on the task force. That speech, if you haven't read it, is really worth looking at. It's on the Bank of England website. So just to my slides briefly. The genesis, obviously, climate change has become a mainstream risk. This is a chart showing risks tabulated by the World Economic Forum in their Global Risks Report for 2016. And you can see in the upper right-hand corner, this is really about combining the likelihood with the impact. And you see that climate change-related topics are really both likely and impactful to hit us within the next decade. Within the next decade. So, and we're all of us seeing more and more distressing scenes on our televisions. Global migration caused by the ravages of climate change already today. So at the COP last year, at the Paris COP, Mark Carney, together with Michael Bloomberg, established the Task Force on Climate-Related Financial Disclosure, bringing together a number of diverse actors from different parts of the financial services industry and from industry itself. And the idea is to really standardize on a global basis reporting around this topic. There are clearly a number of organizations who've been doing very good work on this topic for a long time, CDP and others, but really what this is about is trying to standardize reporting practices globally, and also to get companies and financial services companies who are not currently reporting around this topic to bring them into the fold, as it were. So this task force is, of course, about advancing the debate and going forward with the work that has already been done in this field, but it's also about broadening and bringing into the fold, getting people to report who are perhaps currently not looking at this. And that is why the recommendations that the task force makes later in the year when it publishes the report, or the report will be finalized and published, I think, in the first quarter of next year. But it will be voluntary disclosures initially and will be presented to the G20 via the FSB, and it is hoped, we hope that some of the G20 governments will look at this as a very useful contribution to the debate, and perhaps, fingers crossed, some of them will think about implementing in their own jurisdictions. Of course, the French government has already gone that distance with its energy transition law and the famous, by now famous, Article 173, which requires companies to disclose their carbon footprint and investors also to disclose the footprint of their portfolios, and also to say how they are complying, how their portfolio complies or not with a 2-degree world. So 2-degree scenario analysis, I think, is going to become a much more widespread practice, hopefully, going forward. The work of the task force was divided into 2 phases. The first phase ran from January through to April. A report was published, and these were the initial findings in terms of what the task force sees as 7 fundamental principles for effective disclosure. So present relevant information, be specific and complete, clear, balanced and understandable, consistent over time, which is very important, comparability among companies within sectors, industries, and portfolios, reliable, verifiable, and objective, and be provided on a timely basis. The first phase report was published at the end of April and then put out to public consultation. Task Force received over 200 responses to it, some of them very detailed, one from the PRI in particular, but many organizations, many investors, some industrial companies. So we did get a very good view of what the audience we are trying to address thinks the targets should be and what effective reporting should be. And the phase 2 work builds on that consultation exercise, and we're looking to identify the gaps in disclosure and identify who is already doing, where best practice is, with a view to delivering recommendations that improve consistency, accessibility, and so forth. We have our next plenary meeting next week in Paris. The final report is in the process already of being drafted. And at each of these events, when we have a plenary meeting, we always do a public outreach event. So we have a meeting in Paris before the formal 2 days of the task force where we will be reaching out to companies and investors in Paris. This is very important to get as much outside feedback as possible into the work. The idea is that we will present the report to the FSB in November, and then I think there will be further opportunities for feedback, and we will then present the final report to the G20 with the German government in the chair of the G20 by then for final publication in the first quarter of next year. And the focus in phase 2, we're really focusing in terms of how we want the disclosure practices to look. We've identified 4 key areas: the governance of companies, how they are thinking about climate change, what they are, where is the accountability in organizations around the issue of climate change, hugely important topic, strategies that are being adopted to deal with it, risks that companies identify and how they look at it, and crucially also, of course, the metrics, what metrics are companies using and how can we best standardize those metrics for all companies as a whole, but also on a sectoral level. So we are doing a lot of individual sectoral work. The task force is divided into work streams that look at governance, look at the non-financial sectors, and looking also at the financial sector. And so there will be recommendations for all companies, but there will also then be recommendations at individual sectoral levels, because clearly some companies make a bigger contribution to climate change than others, and it's very important to identify what their risks are. But also you have other companies where the risks may not be immediately obvious, and you've got to use different tools for addressing the different risks in different sectors. How can you engage with the Tcfd? So we have some social networking sites, and there's a Twitter feed. They're on LinkedIn and Viaggio, I think, or Vimeo. So if you go to the website of the task force at fsbtcfd.com, you will find lots of information, all of the feedback from the phase 1 consultation in a nice handy PowerPoint pack. So I urge you really to look at that and get involved and give your views.
Great, thank you very much for that terrific overview, Mark. So you may have lots of questions. I'm going to ask you to just hold on to them a little bit. You will get a chance to ask them. And first, I just want to ask our panelists to share a few reflections with their unique perspectives. Lien Sim, as the Singapore Stock Exchange, can you just share with us in a couple of minutes how you see transition risk and climate opportunity within the Singapore context, and also what kind of role can stock exchanges play in promoting disclosure?
Yes, so climate change is, if you like, a subset of the environment. So companies here from next year will have to report on their sustainability practices and metrics. And so they will now have to look at climate change a bit more specifically and sort out what's climate, what's pollution. Probably it's related, but it's an extra exercise. So I think we should see this as something else we are asking companies to be more precise about. And so there's work to be done. This is relevant for companies. For example, we have an active offshore oil and gas support sector. So you can see how directly relevant it is. And to quote you another example, there's real estate developers form a significant portion of our list. And so here too, climate makes a big difference for them in the longer term. Some of them are already among the global best reporters because of what they've been doing. So I think this is just probably not such a great stretch. But for individual companies, I think each of them will have to look at this and make it relevant, do the material reporting. And as to exchanges, I think we're a platform for encouragement and also to help sort out questions and difficulties, a useful go-to, and we'd be prepared to play that role if necessary.
Thank you. And while exchanges can play a role in trying to promote disclosure and improve that over the long term, at the same time, what we've seen over the last couple of years is investor dissatisfaction, and that's been expressed through active ownership and shareholder resolutions. Helen, just turning to you, you've led on some of the climate change resolutions that have had very strong investor support this year and in previous years at Anglo, Rio, Glencore this year. Could you just share with us a bit, what do the 2016 and 15 resolutions on climate change tell us about company disclosures today and what really needs to happen so that in time, perhaps these resolutions aren't even needed?
Great. And Sagarika's also asked me to give a little bit of background, so I thought I would cover why we launched an asset owner-led coalition focusing on climate risk, why use resolutions within that, and then finally why we're so supportive of the task force's work. So firstly, why build an asset owner-led coalition looking at these key sectors, oil and gas, mining, utilities, autos, etc. CCLA is owned by its church and charity clients. 70% of those clients have very little interest in ethical investment, typically just a tobacco screen. And the Aiming for A coalition was developed for them through a responsible investment shareholder value lens. It was very much driven out of those seminal reports from Carbon Tracker and Mercer in 2011, highlighting these systemic risks. And we felt we needed a coalition because when you're talking about tragedy of the horizon, tragedy of the commons, you need to work together. It's a collective action problem. But why resolutions? Well, firstly, it's very important to remember that our primary mode of working is engagement. I lead the engagement work on BP, and up until the AGM last year, the engagement work with BHP Billiton. My own very intensive engagement work with both those companies started in 2010, and the shareholder resolutions weren't around until the 2015 AGM. Resolutions are just part of a really important intensive engagement journey. But we do feel they have a role to play because they can amplify the voice of the long-term investor. Companies, whether it's management, the executive or the board, find that quite often the voices of long-term investors get drowned out by short-term market signals. So we do need to find ways of amplifying the long-term to help with the tragedy at the horizons. We also wanted to show that although a lot of investors are underweight in these sectors, we're also wanting to be stewards for the long term. So we felt it's very important to be both supportive and stretching with our disclosure asks. And of course, as the AODP report from Tuesday shows, resolutions are a very public part of engagement, so they do allow accountability back to asset owners and ultimately citizen investors as well. So why do we welcome the task force's work? Well, I think the really important thing is that the second bullet point of our resolution so far has focused in on scenario analysis, the idea about resilience to the different IEA scenarios. And we think that's incredibly important as a basis for disclosure. So we're very excited that that's a key element of the task force's work. We also, as Sagarika hinted, are hoping that we don't, in Europe particularly, need to go through the very painful administrative process of filing very many more resolutions once the task force recommendations are up and running. And indeed, we're going to be aiming for a much closer to the Institutional Investor Group on Climate Change's corporate engagement group, and bringing those two initiatives very closely together as we originally envisaged from 2012. And we're just very excited that this is a new phase for 2016 to 2020 and can really help catalyse the work of IIGCC, INCR, and the other regional initiatives, plus UNEP-FI, CDP, and of course PRI's own work on climate change.
Thank you, Helen. Now, Anthony, you've worked with investors particularly on financial analysis of these issues, really speaking to investors in their language about how they should think about these kind of topics. You saw the poll results earlier on scenario analysis. There were some investors aware probably of what that is, some actually starting to use it. Can you just share with us a bit, from your financial analysis think tank perspective, how could better company disclosure on scenario analysis, stress testing, be a game changer in how investors actually assess risk? And could you just wrap in a very kind of quick definition of what we mean by scenario analysis? It's been mentioned a few times.
Well, I mean, maybe start with our greatest fear out of all of this, and then perhaps our sort of hope. We're already seeing some companies producing stress testing, 2-degree stress testing. But I don't think it's surprising that a lot of the stress testing coming out of these companies is starting to say, well, we're okay. You know, we're 2 degrees compliant. It's everyone else's problem. Now, our experience of looking at demand scenarios that the energy companies produce, and our Lost in Transition report is a good example of that, if anyone wants to find that on our website, is that the companies, that there's a high degree of groupthink going on across the energy sector. And the assumptions picked in many of these demand scenarios that the companies put out, unsurprisingly, give them the answer they want. So, for example, in our view, they pick the highest assumptions for GDP growth, population growth, but some of the most pessimistic assumptions for the growth of clean technologies like solar and wind and energy efficiency. So it's not surprising that what comes out of the other end is, high projections for growth. What we want to see is a degree of transparency and comparability across the market in the scenarios, so that we're very clear in the assumptions that are being picked, perhaps even baseline assumptions that the companies have to sort of stress test or reference their scenarios against, and then stress tests are done against those sort of standardized scenarios, if you like. So you're not comparing apples with pears, but you're comparing apples with apples. I mean, I think that's absolutely critical, because otherwise, we're likely to get a whole series of 2-degree stress tests from companies right across sectors, and every single company is saying, well, we're 2 degrees compliant. It's everyone else's problem. So what do we mean by, sorry, your question about a scenario? Well, if you're stress testing, we're talking about stress, this is not backward looking anymore. I mean, a critical part of this is looking and trying to sort of assess what's going to happen in the future. And of course, this is what, certainly in the oil, gas and coal sector, what many companies do with their demand scenarios. They're projecting into the future. Now, what we found, many of those companies, what they actually publish is their best case, that justifies growth for their business, and they don't tend to talk to investors about the more pessimistic scenarios. So critically here, we need a range of scenarios for different outcomes, different views of the future, because none of those are likely to be exactly how the future turns out, but at least if you have a range, you can see how the business might cope in different circumstances, and I think that's critical. So from sort of 2 degrees up to business as usual. But when you do a stress test, you need a view of the future against which you're stress testing. And that, I mean, in a sense, in the simplest form, that's what a scenario is. It's a view of the future and how the future might turn out. So, one view obviously is if the company is moving on a 2 degrees pathway, and this is the 2 degrees pathway. Another view may be, well, actually, we don't believe that's going to be the case. We don't believe we're going to deal with climate change. So here's a business as usual pathway. But at least if investors have got that range of scenarios, they can then take a view, as opposed to, in our view, what companies have been doing to date is cherry picking, an assumption or a scenario that justifies their case for growth, rather than saying, okay, well, this is what we think investors is going to be the case, but actually these more pessimistic, as far as our business is concerned, these more pessimistic alternative cases may also come to pass. Now, you investors have this range, you can now decide, rather than being given just one. So I think that's, from our perspective, is critical. Now, I'm not going to run through it. I could talk through the questions, but we've put a sort of briefing note on the app, which you can look at, where we set out a series of questions, and we run through those. So I'd encourage you to look at those. I would also encourage you to look at our Lost in Transition report on the website and our Sense and Sensitivity report. Because I think, at the end of the day, it is critical that the moral and ethical case for this is made. We've got to make the financial case, and I think that's another critical part of what we're doing here in the disclosures. Now, we had a gut feeling for a number of years based on our analysis that actually there's a strong financial case for a 2 degrees pathway. In our Sense and Sensitivity report, we did a sensitivity analysis, and our conclusion is actually there's a strong financial case for putting the biggest energy companies on a 2 degrees pathway, and actually that would be good for their share price and good for their ability to pay dividend.
Thank you. I just wanted to explore a bit more the scenario analysis, particularly as the poll results indicated that investors might be thinking about how they can use this. Now, Mark, you published a piece of research this week, and you've been looking at scenario analysis, incorporating it within your mainstream financial analysis for some time. Could you just share a little bit on that, and also your view on what kind of information you need as a mainstream regular financial analyst, if I may call you that, to be able to analyse and properly assess companies and give your views on them to your investor clients? What is it you're not getting?
Yes. Well, I mean, thanks for the question. As my day job is to cover the utility sector, and I cover the German utilities. And Mark Carney talks about the German utilities as an example of transition risk. And if you look at where the German utilities were 10 years ago, they were some of the largest companies in Europe. I mean, I think E.ON at its peak had a market cap of 95 billion euros in January 2008. RWE had a market cap of 60 billion euros at that time. And both companies since then, since January 2008, have lost about 85% of their market value. Now, not all of that value loss or value destruction is down to their misreading of the rapidly changing landscape in European energy markets. They've been hit by the nuclear issue as well, but a very significant portion of that loss is down to the fact that they, I think, in some ways misread the signals. And to Anthony's point earlier, were not alive enough to how quickly business as usual was changing, and that's why Mark Carney advances them as an example of transition risk. I went through their sustainability reports, I went through their emissions. Obviously, the power generation industry is the largest single contributor to anthropogenic greenhouse gas emissions. And so the Scope 1 emissions are really where it's at with utility companies. As I said earlier, different sectors have different climate change sensitivities. For utility companies, it's really all about Scope 1 emissions. And when we're talking about the policy response to climate change, everybody over time is going to have to reduce their emissions if we're going to meet the target that the entire world has signed up to. at Paris. So I tried to do a 2-degree stress test of the German utilities business. How do you go about that? It's partly about getting the information from the companies themselves, and actually what you find in their sustainability reports is that they do give a lot of disclosure. It's not forward-looking, and that's the next challenge for some of the leading companies that are out there, but there is a huge amount of information in there. And then the trickier question is, whose scenario do you take?
Right.
And at the moment, really, the IEA is the most comprehensive and the most widely referenced sensitivity analysis around 2 degrees. So what I did quite simply was to say, here's what the IEA assumes emissions have to fall to under a 2-degree scenario within the European power sector. It's all laid out in the World Energy Outlook. So if you assume that cap, what does it mean for the European carbon market, and what does it mean for carbon prices? And you can run those analyses. And on that basis, clearly, you would see the conclusion I reached was you would need a much higher carbon price than we have in Europe today. Everybody knows that the carbon price is very depressed. I think you would need a carbon price of 45 euros a ton to get Europe towards meeting a 2-degree policy target. That would radically change the so-called merit order of power generation, and you would see lignite and coal, which are still generating ahead of gas in Germany at the moment. So Germany, despite being a global leader, perhaps the global leader in renewable energy, still has very high emissions in its power sector, and those have to come down. They have to come down. So one way or another, we will have to put in place a tighter carbon policy framework, and what I did was say, if we do that, this is where the sensitivity is, and clearly, the lignite and coal businesses suffer greatly under that scenario, and their value falls, whereas the gas business, which is the transition fuel in the power sector in Europe, that would come into the mix. And so when you do that, you can figure out what the share price sensitivity is, because you can see that if currently a company is making a lot of money from lignite and coal-fired generation, they will not make that same money in the future as the cap tightens, as I believe it will have to.
Thank you, Mark. So I'd like you, the audience, to start getting your questions ready. As you're doing that, Martin, I wanted to turn to you and ask you, you've been speaking during this conference about some of the steps PRI is going to take in terms of our 10-year responsible investment blueprint strategy, about long-term investing, just bringing this back to what the task force means for PRI signatories. What would you actually like to see come from the task force, and what's needed to make a difference to our PRI signatories here today?
Yeah, thank you. So I think for me, the desired outcomes of this process is, well, many things, but let me mention 3. One is, for me, a stronger focus on financial risk. So we have many existing reporting frameworks today, but many of them, not all of them, but many of them are focused on demonstrating how companies affect the climate. So there's a lot of focus on physical emissions. What we're looking for as investors is not so much how companies affect the climate, it's how climate change and climate policies affect the companies. And those are related things, but they're not the same. So I think it's a very promising approach for the task force, as outlined here, that we focus on strategy, governance, the business process of these companies, because that will inherently make the reporting more forward-looking. And if you think about this as an investor, any investment decision is really about comparing the investment you make today against an expectation of the probability distribution of future cash flows. So it's really about getting a better sense of what that probability distribution looks like under various assumptions about climate change and climate policies. And that builds, I think, very much on the approach that Carbon Tracker and others have had, focusing on the financial aspects. So we need, I think, a better framework for reporting that's relevant for those types of exercises. The second thing I'd like to mention is the need for a greater convergence of existing frameworks. So in the phase 1 report that we published earlier this year, we had identified about 400 existing reporting frameworks globally that have some relevance to this issue of climate change. I think it would be a failure for the task force if all it did was produce reporting framework number 401. That's not really what we need. What we need is a greater convergence of the existing frameworks, making sure that they capture more of the forward-looking aspects and the financial aspects of climate change. The third issue I'd like to mention is that we have to remember that when it comes to data and reporting, it's not just an issue of increasing supply, but also understanding how we can increase demand. So there is perhaps an implicit assumption that if we just provide more and more data to the market forces will mean that it's automatically picked up and used. But we know that in this delegated investment chain, the incentives that investment managers have to actually utilize this data in their investment decisions depends on the mandate that they have from their clients. So we need to understand how the reporting framework that will apply not just to companies that are fossil fuel companies or other industry sectors, but also will apply to investment managers and asset owners, how that reporting can create proper incentives for increased demand for this data, and that is actually being incorporated. So if you look at specifically the role of the PRI, I'd say, well, number one, this was said at the SGM, and it's been repeated several times. We've asked our signatories what is the sort of greatest responsible investing challenge that they're facing at the moment, and what would they like the PRI to concentrate its efforts on. It's climate change is the number one issue. So following up on the task force recommendations obviously is very well aligned with the priorities of the PRI and the priorities of our signatories. So our role, I think, would be number one, promote the adoption of the task force recommendations and recognizing that it's not just about adopting them among our own signatories, but also that our signatories can play an important role in promoting adoption in the companies that they have invested in. So this is an important task for us to see how we can go about promoting this. Secondly, I think it's about developing in our practices documents guidance on how to apply these principles once they've been adopted, and also over time develop more guidance and material on how investors can usefully interpret this data and use it in their investment decisions. So this is something that we do regularly for a whole range of issues, developing, showcasing best practices. So when investors develop good practices for the use of this data in their investment decisions, we should try to make guidance documents that would disseminate this knowledge to our signatory base. And I think it's natural for the PRI to have a close look at how we can promote convergence of existing reporting frameworks. We know that our signatories report a lot to many, according to many different frameworks. We have our own reporting and assessment framework, so we need to see how the task force recommendations can be aligned with that and how we can use that framework to promote the adoption of the principles and the task force report. And finally, this issue of the demand for data, I think, falls well within the scope of work we're doing already in terms of understanding the nature of the relationship between asset owners and investment managers and the various principal agent problems we have in that delegated investment chain. So this is something that we are working on, and I think we need to look at this issue in that context and see how we at the PRI can promote greater use of this data and recognizing the principal agent problems in the delegated investment chain. So I think really all of these issues for the task force are highly relevant for the PRI and will have to be an important part of our work in this going forward.
Thank you very much, Martin. So I'm going to throw it open now to you, the audience, for questions. I see we have one down here, straight off. I'm going to ask that one first. And if you can please identify yourself and if you have a particular person you'd like to direct your question to, please do. And please keep your questions short. No speeches, please.
Thank you, Sagarika. I'll direct my question to the panel. Clearly, the task force is a fantastic intervention. We may look back at it like, we view the Marshall Plan after World War II as a great intervention. I think one of the greatest next interventions could be getting asset owners to help drive this. So I am looking for strong recommendations from the task force on asset owner disclosure, including integration of climate asset risk in their investment strategies, and sort of putting that out there. On a scale of 1 to 5, where 5 is very happy and very sad, how does the panel think I will view the publication of the Phase 2 report?
Okay, so I'm going to slightly translate that question into something slightly more diplomatic, which is how will the task force promote asset owner disclosure and engagement on this, and if you are an asset owner, but actually how happy will you keep this gentleman here on this topic? And I'm actually going to direct that at Martin, if I may.
Well, I absolutely agree with what you're saying. I think that, as I said, I think asset owners have a responsibility to drive this, because if this is not demanded from asset owners, I think the incentives for investment managers to address this will be too weak. And if investment managers don't address this and don't really use this data, I think the incentives for companies to provide it will also be weak. So it really starts with the asset owners, and this is well in line with sort of our thinking. I think that at the PRI and the incentive, our focus on asset owners, and I think the task force recommendations will have to apply to asset owners, and they will have to have that focus of incentivizing asset owners to do this. So I hope that you will at least be sort of 4.5 happy.
Terrific. Thank you. Question at the back.
David Harris from London Stock Exchange Group and FTSE Russell. We very much welcome the work of the task force. We're one of the respondees to Phase 1. There's a lot of focus on carbon emissions, carbon exposure, which is very important, but surprisingly little focus on industrial change. A lot of large businesses are hugely changing their business mix, and there's a lot of growth of green economy sectors, but often coming from large and diversified companies, which is often not captured by the market. We've spent a lot of time trying to map the activities and the industrial output of companies globally. But a real challenge is revenue reporting, companies providing better segment and sub-segment revenue data. Is this an area that the task force will be looking at?
Okay. Mark, I'm going to ask if you could answer that question. So it was a question on industrial change and the extent to which the task force will look at segmented revenue data to assist investors that are thinking about industrial change.
Well, I mean, it's a very good question, and in the Phase 1 feedback that the task force received, there were a lot of metrics that are not necessarily directly related to the specific brief of the task force that did get talked about. One of the most similar to revenue, but one of the most commonly cited things that people would like to see is a focus on companies' capex plans going forward. Where are they planning to put their capex to work? There are issues here around forward-looking disclosure that come up as well, and I think it's worth pointing out that there is in particular something of a divide between the engagement with European companies and the engagement with North American companies who often refer to SEC rulings on forward-looking disclosures. This is something we're having to factor in to the work of the task force as well. So, I mean, on the specific point about revenues, I'm not sure that we're going to be putting that in as a requirement, but I think implicitly factors like that are very much in the thinking of the task force as we prepare the guidelines.
Thanks, Mark. Another question down here. Do you have a microphone? Oh, I'm sorry. Okay. Thank you. And if you just please say who you are.
Max Horster from Southwell Group. I have a comment and a question. The comment goes to the Aiming for Air Coalition and Martin's comment on demand. Together with the CDP, we helped stocks, an index provider, to actually make the A-list investable as an index. And so you there have kind of a nice adding a carrot to the stick logic, where the stick is the aiming for A engagement, and the carrot is if a company achieves that, makes it on the A list, the investor who does both, investing and engaging, actually offers to the company to then invest into it when it achieves that. And I think we need more of these type of logics where investors also reach out to companies and say, you become more investable for us. My question would be for the two task force members on the panel. Can you put some color on the politics behind the scenes, the biggest pushbacks and roadblocks that you face?
Okay, so I'm going to ask Lien Sim, if you could share a bit on some of the high-level challenges that the task force has considered up till now.
I have trouble deciding on which ones, because
there you go, very candid, transparent process this is.
Not least of all that it being such a major and far-reaching issue, that there are many considerations about who is involved and how the extent of involvement. I think that the important thing is that we are focused on something that is practical, consistent, and useful for the market, because this is a market-based solution. And if we can come to that agreement with the various market users and preparers and intermediaries all the way through the chain, both in the financial sector as well as for the non-financial sector, then you have a basis for something that I think everybody is looking for, be they market participants like here in this room, or regulators and governments, that it can be useful and sort of decision relevant for future use.
Great, thank you. Any other questions? Okay, sorry, thank you. Just one at the back there, thank you, and then we'll come to you at the front. And if you can keep the comment section light, if you don't mind.
Thanks. It's David Russell from University Superannuation Scheme. We're fully supportive of the work of the task force in increasing transparency. Heard a lot talk about how it's going to apply to companies and how asset owners need to drive asset managers in increasing this transparency. We don't just invest in companies, we invest in all sorts of other asset classes. Our biggest exposure is UK government bonds. We invest in private equity where there's no transparency in any ESG data really, being very black and white here. We also invest in hedge funds where we might be shorting companies. Has the task force thought about how we get that transparency in all the asset classes we invest in rather than just companies? Because in that way we can be fully transparent in our total carbon exposure.
Thank you. Martin, if I could ask you, how will the task force look at asset classes and provide some applicability to those?
Yeah, so this is a very challenging question, and it adds to the list that Leon Sim said about challenges. So the focus naturally on reporting framework has been on reporting entities, right? And so it has been natural for us to look at how we can look at this issue in the context of the reporting that reporting entities does. But we are aware that there are many asset classes where this is not necessarily a viable approach. So there has to be guidance on this following from the overall principles. But I think it's important to recognize that the level of ambition has to be seen in the context of the extremely tight timetable we have for this report. So I think this will be high-level principles, but sitting underneath that will have to be guidance on implementation, application across sectors and asset classes. And this is something that needs to be developed as a supplement to the high-level principles. There will not be a fully fledged, comprehensive, detailed reporting framework for each and every sector and each and every asset class. That's simply not doable within the time frame that we've had. And this is, as I said, I see a role for the PRI in trying to develop with our signatories guidelines, implementation guidelines for how we can apply these standards at a company level, but also at an asset class level. This is clearly something that we need to work with our signatories on.
Thank you, thanks very much. We just had a question. Do you still have a question? Thank you. And this side of the room, you have about 2 more minutes to come up with some questions. It's been a very quiet side of the room.
Andy Mason, Standard Life Investments. I have a question for Mark. I'm not going to bother with any comments. It's a slightly technical one. We've been stress testing portfolios in relation to climate risk. And one of the areas that we found difficult with utilities was how we reconciled geographical footprint, type of asset, and varying regulation. So I'm just wondering how you went about doing that.
Yeah, well, that's a very good question. And the practical difficulty is companies report differently. You know, some of them, the very practical example, RWE reports its power generation activities as Germany and the rest. E.ON reports Central Continental Europe and UK separately. So that is tricky, and you spend a lot of time going through company reports trying to reconcile these numbers. There's no easy answer to it. The way I went about it was to say, we know that Germany is the most important for both companies still, and that's where actually most of their emissions are still, with the coal and the lignite. And that was relatively straightforward to identify. In E.ON's case, it's not quite so easy to isolate for Germany because of the way they present their numbers. It goes back to the question on revenue reporting. Something as simple as, you know, where they are making their money is not always as straightforward. So it is an implicit point. But the full methodology is set out in the report. I think there might be a copy on your table, so have a look at it, and we can have a longer chat afterwards.
Thank you. And we're just going to take on one last question, which is there. Thank you.
Thanks. Julian Poulter from the Asset Owners Disclosure Project. Does the panel think that previous efforts by the FSB to look at financial stability are relevant in this case? Because if you've read any of the papers that the FSB actually produced after the subprime crisis, only a few of them were about gaps in data. I mean, there were some significant papers there, and I thoroughly recommend everybody go and read them. But at least 2 of them were about agents relating to the financial system, building on David's point. So how can we possibly, or rather, does the panel think that there is a risk that we're going to add a lot of data to various systems, potentially unconnected data, when in fact the real issue may lie somewhere else in one of the agents, such as the ratings agencies, again, which might cause, you know, what Mr. Carney described as the wholesale reassessment of prospects?
Julian, could you just say your question just very briefly?
So do you think that we're going to miss the point when we produce the phase 2 report, and that actually, unless we're looking at the quality of some of the risk data, for example, in the ratings agencies?
Yeah. Okay, thank you. Mark, would you be able to take that question?
Well, I mean, you know, I've focused, this task force covers a vast range of industrial sectors. You're trying to capture the entire industrial output of the planet, plus asset managers and banks and everybody in the financial services industry. It's a very demanding effort, and I think that I don't think we're going to miss the point. I think, you know, my special focus has been in the non-financial work stream, looking at the energy companies, because that's where, you know, my expertise lies, and it's where also most of the emissions are. So I think people will find, according to their own perspective that they bring to this, that they may or may not see elements that could have been done better. Inevitably, you know, Martin referred to the tight time frame we've got. This is not going to be a report that solves all the issues, and it's not going to be a report that pleases everybody. But I think the central point will be very extensively covered, and I think this will then the point will turn to implementation, and the implementation is going to be as important. And I would stress again the point I made earlier. This is not just about depth and advancing the debate, although that's clearly a hugely important dimension to the work, but it's also about breadth and getting companies who are not currently thinking about these issues and who are not currently reporting anything on these topics, to get them involved as well.
Great, thank you. Anthony, just to finish off, you got away very lightly. You didn't seem to get any questions here. So I just wanted to ask you, sort of to wrap up, imagine 2017, we have the task force's recommendations, PRI and many others are out there promoting adoption. What would you like to see individual country governments actually do next? What could their role be in trying to promote the FSB's recommendations and some of the things you've talked about, like better disclosure on scenario analysis?
Well, if you want the more detailed answer, we haven't got a lot of time, again, go to the briefing paper we put on the app, because we've set out our 3 questions. You know, what should the task force consider around scenarios and disclosure? Why is it important for companies to provide this disclosure and assess the risk? And critically, what does Carbon Tracker want to see? I mean, what we would like to see is not blanket disclosure. I mean, blanket disclosure of just more information is not going to be helpful. Recommendations that encourage, I think, the country regulators to delineate the actual risks and then come up with disclosures that are targeted and address those risks, which is actually why, you know, stress testing against concrete, you know, forward-looking scenarios, you know, should encourage that. So all the signs are that we're going in the right direction. I mean, ultimately, and I think we're beginning to see signs of this. Governments, you know, we heard from China yesterday. I think the French are probably considering this, and others, is taking these, fleshing them out, and organisations like Carbon Tracker are, you know, standing ready to help in terms of fleshing out and putting methodologies around the recommendations. But I think making this, you know, move in as quickly as we can from voluntary to mandatory. And certainly if some governments like China and the French government act in that way, I think that would encourage other governments to do that. I mean, and just, I think, you know, a final point. I mean, be very clear about this, and you know, much of the Carbon Tracker demand analysis and other demand analysis makes this clear. It is not just about climate change and climate policy. It is about the demand destruction from a massive technological revolution that we're going through. And I think that's the biggest threat to these business models. In many ways, you know, in the immediate, you know, in the next couple of years, is the emerging alternative technologies. And many of these existing companies, you know, like many incumbents before them, are blind to the technological revolution that is now underway.
Thank you. Well, I think we're going to have to finish soon, as we have a very exciting next session. So just to kind of wrap up, I think we've covered some of the issues that the task force work has brought up, how these relate to Singapore, the role of different actors like stock exchanges, like investors, asset owners, and the role scenario analysis might play. I think you have a flavor of what some of the challenges are. And Mark, the next step immediately for PRI signatories is to, of course, read the report when it comes out in December. As Martin mentioned, PRI looks forward to supporting you in implementing the recommendations. And with that, I'd like to wrap up and thank our panelists. Thank you very much.